Now it's time to take a look at some individual momentum indicators. I'll explain each of them and illustrate their strengths and weaknesses by way of some actual marketplace examples. Specifically, I'll be covering the RSI, the MACD, and the stochastic. So let's get started with the RSI.
RSI formula not only provides a smoothing characteristic, but also results in an indicator that fluctuates in a constant range between 0 and 100, because those are the theoretical limits. The default time span recommended by Wilder is 14 days. Now he justified this on the basis that it encompasses half of the 28-day lunar cycle. In actual fact, the corresponding monthly trading cycle is closer to 20 days, so there's no real logic in the choice of 14 as the default span. It really doesn't matter because it works well, and that's what really counts. Indeed, the 14-period span seems to work well on many different time frames from intraday to monthly. The RSI advantage is that with a 14-period time span, the overbought oversolds can be plotted at the same level for every security. This will be 70 for the overbought and 30 for the oversold. The equilibrium line, which is not usually plotted, would be at 50, in other words the halfway point between 0 and 100. The relative strength indicator, or RSI, was the momentum indicator or oscillator that measures the relative internal strength of a security against itself, and in no way should be confused with the principle of comparative relative strength. That's when a stock is compared to a market average and the result plotted as a continuous line. Rising relative strength is bullish because it means the stock is outperforming the market, and vice versa. When compared to the rate of change, the RSI formula aims to overcome two problems. 1. Erratic movements, and 2. The need for a constant overbought-oversold trading band for comparison purposes. Erratic movements are caused by sharp alterations in the values, which are dropped off in the calculation. For example, in a 20-day rate of change indicator, a sharp decline or advance 20 days in the past can cause sudden shifts in the momentum line, even if the current price is little changed. The RSI attempts to smooth out such distortions. It's important to note that the magnitude of the oscillations of the RSI are inverse to that of most other momentum series. For example, the rate of change indicator is subject to wider fluctuations the longer the time span. It works in an opposite way for the RSI. Since the equilibrium or halfway point for the RSI is the 50 level, it's traditional to place the overbought and oversold lines equidistant from this point. We should remember that longer time spans in the RSI calculation result in shallower swings and vice versa. Consequently, the 70-30 combination is inappropriate when the time span differs appreciably in either direction from the standard 14 period. The middle part of this chart for the Hang Seng Index in Hong Kong features a 9-day RSI, where the 70-30 combination for the 9-day RSI does not indicate a strong probability of a reversal when it's touched, and that's because it's touched or exceeded far too often. Similarly, this same combination is rarely touched with the 65-day span. On the other hand, the bands have been widened for the 9-day in this chart and narrowed for the 65-day span. The 80-20 combination gives a much better feel for the overbought-oversold extreme than the 70-30 default value for the shorter span 9-day RSI. Conversely, the 52.5 and 37.5 combination is a better fit for the 65-day RSI. None of these are perfect solutions, but remember, in technical analysis we're trying for consistency, never for perfection, which I guarantee can never be achieved. The terms long and short time spans refer to the type of data under consideration in a relative sense. For example, a 60-day RSI would represent a long span for daily data, but for monthly numbers, a 60-day, that is 2-month span, would be very short. Some consideration should therefore be given to this factor when the choice of a specific RSI time span is being made. This slide features two RSIs for similar time periods. 40 trading days, and 2 months. However, the overbought oversold lines are drawn at different levels because one calculation is based on daily and the other on monthly data. Obviously, the character of the indicator changes as well. The daily parameter is much more suitable for trendline construction. On the other hand, the arrows in the chart on the right show the possibility for overbought oversold reversals generating signals. Thus we can conclude that RSI parameters based on shorter-term time spans are more volatile, and therefore more suitable for pointing out overbought oversold conditions. But on the other hand, longer-term spans are more stable in their trajectories and lend themselves better for the purpose of constructing trend lines and price patterns. The nature of the RSI calculation allows the accurate comparison of different securities on the same chart. In this one there's two series, the Dow Jones Utilities and the Philadelphia Gold and Silver Share Index. The upper panel plots a 45-day rate of change and the lower one a 45-day RSI for both securities. With the ROC, it's not easily possible to compare the two. That's because the utilities are far less volatile. On the other hand, you can see that the divergence in volatility is far less for the RSI. Because of this, it's much easier to establish universal standards for the overbought and oversold benchmarks that can be applied to any security. In practice, a 14-day time span works quite well, but only for shorter periods. Other useful spans include 9, 25, 30, and 45-day. For weekly data, the calendar quarters operate effectively, so 13, 26, 39, and 52-week spans are adopted. And as for monthly charts, the same recommended spans as for the ROC are also recommended for the RSI. In other words, 9, 12, 18, and 24 months. The RSI can also be used in conjunction with trendline violations. Generally speaking, the longer the time span for any particular period, that is daily, weekly, or monthly, the better the opportunity for trendline construction. Important buy and sell signals are generated when trend lines for both price and the RSI are violated within a relatively short period. This chart features a 14-day RSI for Caterpillar. The RSI starts off after a decline by forming a reverse head and shoulders pattern, which is more or less simultaneously confirmed by the price. After a good rally materializes, the RSI violates this uptrend line. Note how the extended line becomes resistance for the final rally. We can also construct a trend line for the price. Finally, the RSI completes a broadening formation with a flat bottom, and a nasty downside break ensues. The next rally peak also experiences a small RSI top, which is confirmed by a trendline violation in the price. Here we see an hourly chart for Intel. It has a 45-hour RSI in the lower panel, which roughly corresponds to a week of trading. I've drawn the overbought and oversold lines at 62 and 38. See what a nice combination of trendline breaks we get in April 2011. We see another setup in late June where a trendline break on the RSI is confirmed by one on the price. It's even possible to observe a right-angled triangle. If I put in the equilibrium line at 50, it's apparent that the strong late June breakout develops slightly above this critical point of balance. Very long-term charts going back 10 or 20 years seem to respond well to a 12-month time span. Here's one for the S&P Composite. Reversals from beyond the 30 level have traditionally given some remarkably good signals, as you can see here. Even reversals from slightly higher levels have done well, as you can see from the dashed arrows. Finally, there's always an exception, and this buy signal at the end of 2001 was it. Sell signals are a bit more problematic because leads are usually longer, as it usually takes longer to build than to tear down. These arrows show that the sell signals work for the most part. However, the 1990s experienced the best long-term bull market ever, and this produced numerous false signals. Anytime an RSI moves above its overbought or below its oversold zone, it indicates the security in question is ripe for a turn. The significance depends on the time frame under consideration. For example, an overbought reading in a 9-day RSI is nowhere near as significant as an RSI constructed with a 12-month time span. An overbought or oversold reading merely indicates that in terms of probabilities, a counter-reaction is overdone or overdue. It represents an opportunity to consider liquidation or acquisition, but not an actual buy or sell signal. This could only come when the price series itself gives a trend reversal signal. More often than not, the RSI traces out a divergence, and here we see a rally and the start of a decline at A. Then the price goes on to make a new high, but the RSI, while crossing above the overbought zone, peaks out at a lower level, and then crosses below the overbought zone again. These divergences are called failure swings. This is a bearish failure swing, and the price obliges with a decline. Now we see a low at A, a rally above the oversold zone, and another decline at green B. Green B, though, develops at a higher level than green A. So when it crosses above the oversold zone again, we have a bullish failure swing. Oh, I almost forgot a very important missing ingredient, and that of course is confirmation by the price. It's a perfectly legitimate technique to smooth the RSI, and one of my favorite approaches is to smooth a 9-day RSI with an 8-day moving average, because the fluctuations are not as great as the actual raw data. The overbought and oversold lines are drawn at 70 and 30, not my usual default of 80-20 for a 9-period span. And that's because the smoothing doesn't allow the indicator to move to the kind of extreme that the raw data does. This chart of Molex contains a 9-day RSI smoothed with an 8-day moving average. Right now I'm bringing in arrows that flag all of the overbought reversals. We're going to filter them for confirmations. For example, the rally preceding the first red arrow was far too steep to construct a meaningful trend line, so I'll take that first arrow out. The second was confirmed by a break in this line a few weeks after the RSI sell signal. The next two were also confirmed. Then we moved to the October 2010 signal, too steep for a line, as was the next one. In March it was possible to draw an uptrend line, and the price completed a small top. Finally, the May signal is removed for lack of confirmation. Summary for the RSI. 1. The RSI is bounded by 0 and 100. Overbought and oversold lines should be wider the shorter the time span. 2. The RSI lends itself more easily to comparing the momentum of different securities than does the ROC. 3. The RSI can be used in conjunction with overbought and oversold lines, divergences, price patterns, trend lines, and smoothings.